Hello and welcome back to my Daily News X. Well, I'm your host, Kramer. Today we're diving into a big issue that affects people across America. The mounting debt burden on U.S. household, why it's growing so fast, who's the most affected, and what you can do about it. Now, if you haven't subscribed to my channel, please hit the like button and just do it if you can. So whether you are 18 or 65, this is worth your attention. So please stay tuned because this actually matters to you. All right, so guys, what's going on with this market today? Well, most Americans are stuck with a massive debt that's growing very fast and for several reasons. I'm going to give you a couple of reasons why so you can understand better the situation and what's actually happening to these people. Number one problem that we have is rising costs of living and stagnant wages. As housing, healthcare, education, and everyday expenses goes up, many people either borrow more or find that whatever they have saved doesn't stretch as far as they used to. We have the easy credit and refinancing. So low introductory rates, for example, home equity lines of credit, HELOCs, car loans, and student loans, all this gives access to more borrowing. So people often use HELOCs to tap into home equity, sometimes to pay off for everyday bills, home improvements, or to consolidate other debts. We have to consider higher interest rates as well and for long terms. Many debts are now more expensive to service. And when the debt is large or for a long term, for example, your mortgage or your student loans, the burden adds up, believe it or not. Let's also consider life events and financial shocks. Yes, because you might be with a job loss, maybe stuck without medical bills, inflation spikes. So people often lean on credit card to cover relief, which adds up to the debt pile as well. Now, how big is the national debt of the debt per person in the U.S.? Here are some of the headline numbers for U.S. household debt, just to let you know. The total household debt is around $18.39 trillion for U.S. consumer credit and mortgages combined. Yes. On a person basis for credit score holding adults, the average debt is about $63,000 as per 2025. Mortgage makes up the largest slice, about 69.7% of all household debt in 2025 is mortgage debt. Breakdown of non-housing debt based on one data source of the non-mortgage portion, meaning auto loans, student loans, or credit cards. According to the Federal Reserve Bank of New York data, mortgage balances or consumer credit reports stand at about $12.94 trillion at the end of June 2025. I'm going to give you a breakdown, basically all of this, so you can get a better picture and understanding. So your credit card balances is about $1.25 trillion. Auto loans in general is 1.66, and the student loans is about 1.64. If you want to put it into perspective when it comes to percentages, I'm going to give you a clear understanding. You have mortgages for 70% of the total household debt. Yes, that's the biggest apple. Credit cards amounts to 6 or 7% per person. Auto loans is 9%, and the student loans is equal to the amount of auto loans for 9% as well. These are just rough estimates and approximations. They're not exactly accurate, but I'm just to give you an idea. The average credit card interest rate is about 19.87% for variable as of November 2025. This is according to one of my sources. Another source shows that a new car offers average from 24.04 APR just in November 2024. Now, who's the most affected in this new trend of economic debt? We have age group with the highest total debt. Borrowers from 40 to 49 hold the largest share of total household debt. We're talking about 25.9% of all household debt, according to one data set. The younger borrowers, on the other hand, 18 to 29, have the least total debt, but still carry significant student or auto loans or trading or kind of debts. Let's not forget about the seniors, 70% and plus. They are fast growing group in debt, believe it or not. One study found the debt among those age 70 plus rose from 36% over the past 5 years. You got to consider, they have a lot of medical bills, and prescription they have to pay. So that's what this is happening to them very often. A student loan burden is significant among 30 to 39 years old. The largest share of student debt at a 32.7%, although the total debt may still be less than older age group, just so you know. Now, why are people tapping to their home equity lines of credit, also known as HELOCs? There's a couple of reasons why. As home values rose, many homeowners gain equity and use HELOCs either for large expenses, for example, remodels or emergencies, or to consolidate other debts, meaning credit cards with higher interest loans. With other debts higher costs, like credit cards at 20%, tapping lower cost equity might feel like a very smart move for them. Also, some of the home equity to cover everyday expenses when income lags or unexpected bills comes up. That increases risk because the home is a collateral, just to let you know. According to the New York Fed report, HELOC balances rose $411 billion outstanding by June 2025, and they show growth in recent quarters. Now, why is all of this a concern for a lot of Americans? Well, we have a high debt limits flexibility, guys. When a large share of income goes to serving debt, less remains for savings, emergency, or even investments. Interest rate risk, for example, when rates rise or variable rates adjust, borrowers with high balances and high interest payments face stress. Yes, I'm one of those that happens to me. Collateral risk. Mortgages and HELOCs use the home as a security. So default risk, not just personal credit, but housing instability. Let's also consider delinquency rates because they are rising very fast, especially in the youngsters. For example, student loan delinquency surged in recent quarter per one report. Also, we have a micro risk. When many households are over leveraged, the ripple effects across the economy, meaning less consumption and more defaults, can be very significant as we speak. Now, I'm going to give you 3 practical tips on how to pay off your debt and stay consistent with this. And I think I'm the only podcaster that does this for everybody, on my own personal podcast. So I hope you think about that. Here are 3 action strategies that you, as someone aged 18 to 65, can use to chip away at debt and maintain momentum when it comes to debt. Create a clear and prioritized repayment plan. Number 1, write all your debts, amounts owed, and interest rates and minimum payments. Prioritize, consider paying off highest interest debt first, often credit cards, while keeping minimums on the others. Or you can use the snowball method, which means paying off the smallest debt first. That way, that's just in case you need to feel more motivated, like make you feel winning, but you need to send a lot of money basically towards your principal. Set a monthly debt payment budget line, treat it like a fixed cost. Automate payments, very important when possible, so you don't miss any and get hit with an extra interest or fees. Yeah. Use the windfalls or extra cash strategically. Whenever you get unexpected money, like for example, bonus, tax credit, gift, or side gig income, apply a portion directly to your principal on your highest interest loans. This reduces the total interest you'll be paying in the long term. If you use something like HELOC to consolidate, make sure the savings and interest outweigh any risk of tapping your home. Avoid letting equity line become a perpetual open tab. In other words, don't use it forever, man. It's just a temporary fix. Try to pay off your credit cards as much as you can. Consider refinancing or transferring balances if you can to get a significantly lower rate. I'm one of those. I transferred my balance to a different credit card with 0% interest when it was available, of course. But now it's kind of hard. But only if you plan to pay more than the minimum and don't just stretch the term longer. Build and protect your momentum. Keep track of your progress monthly. Seeing the balance decline provides motivation. Set a small milestones. For example, reduce credit card debt by 50% if you can, of course, in 6 months. And reward yourself modestly. When I say modestly, that doesn't mean, going to a 5-star hotel or eating in a fine dining restaurant or buying electronics, very expensive electronics. Resist new high interest debt while you're paying off the old one. Avoid the rodeo borrowing. That means paying off the debt by taking on a new debt. If you finish 1 or 2 credit cards, avoid getting another credit card or getting to a different payment if you finish paying off your car, for example. Build the most emergency fund, even $500 or $1,000, so that when unexpected bills hit, you aren't forced to borrow against that. Once you have reduced the high interest debt, shift gradually into saving. Listen to this. Shift gradually into saving, investing, so you're not just debt-free, but on track for your financial health and freedom. All right, guys. Yes, just to finish with this podcast. And yes, many Americans are grappling with large and growing debt burdens. And I understand that. I'm one of those as well that has a little bit of debt, and I need to finish paying off a couple of things. Big mortgages, heavy student loans, loads, sky-high credit card rates, and use of home equity to cover costs. The average person owes tens of thousands of dollars, and for many, the debt load is a financial anchor. But here's the hopeful bit. By understanding your debt, prioritizing way to pay off, and using extra funds smartly, and staying consistent, you can turn the tide around. It takes discipline, but the payoff is real. more freedom, less worry, and more control of your life. Thank you for tuning in to my Daily News X. If you found this episode help you, you think differently about your debt, share it with someone who needs it. Next time, we'll dive into how to negotiate with lenders and the best tools for tracking your debt payoff progress. On today, my friend, stay informed, stay focused, and take control over your financial future. Thank you for coming, and have yourself a great day.